As a woman working with other women to help them achieve their financial goals, I am all too aware about the unique challenges that we face when navigating and planning our finances and retirement. At Statewide Super, our goal is to help empower you to take control of your financial future. All women are unique and with different journeys, but some of the challenges we face are the same. During this session, we aim to identify and discuss some of those challenges and give you some tangible and useful strategies to help you on your own journey. So why should we pay attention? Well, 80% of women will retire with insufficient savings to fund a comfortable lifestyle in retirement. On average, we retire with 27% less in our superannuation than our male counterparts. But we live on average 4 years longer. So that means that we're trying to fund a longer retirement on less. And if we don't have sufficient retirement savings, well, for many of us, that will mean relying on the age pension in retirement. Women are more reliant on the age pension in retirement as their primary source of income, which, for reference, is about $26,000 per year. About 1/3 of single women are living out their retirement in poverty, and older women are the fastest growing group of those facing homelessness. There are a number of reasons that contribute to these outcomes. We more than often are the primary caregivers, sometimes taking years out of the workforce. And this doesn't just impact us earlier in our working lives. Often it can result in us retiring earlier as well. In fact, we're 4 times more likely to retire to take on a caring role. So how did we get here? Well, as I mentioned, there are a number of different reasons that lead to such inequality in retirement. In Australia, you are paid your superannuation as a percentage of your salary. Currently, your employer is required to pay 9.5% of your salary into your super fund. This is then invested and it accumulates through to our retirement. As it currently stands, the gender pay gap is sitting at around 16%. So it stands to reason that if your superannuation is paid as a percentage of your salary, and we on average earn less, we will also accumulate less in our superannuation over the course of our working lives. This, coupled with many of us taking extended time out of the workforce, can have a significant impact on our retirement incomes. Understanding the impact of these challenges gives us the opportunity to take control of the areas we can influence. One of the issues that we are faced with is often a lack of confidence, known as the confidence gap. This confidence gap can impact us in many ways, but most notably, how we approach employment opportunities and how we choose to invest. Firstly, I want to address how we look at employment. Recent research from large technology company HP indicated that women working at HP would only apply for a promotion when they believed that they met 100% of the qualifications listed for the job. This is in contrast to their male counterparts, who they found would apply when they thought that they could meet just 60% of the job requirements. When not applying, women were more likely to cite a fear of failure as the primary reason for not putting themselves out there. So next time you are looking at applying for a new job or thinking of asking for a raise, remember, when we don't act or when we hesitate because we're not sure, we are holding ourselves back. But when we do act, we perform just as well as men do. This confidence gap can also impact on how we invest. Investments are broken into 2 categories. Firstly, we have growth assets, including shares and property. With a growth asset, the return is generated by the increase in value of the asset over time. Secondly, we have defensive assets, such as cash and bonds. With a defensive asset, the returns are generated through income, such as bank interest. Growth assets tend to provide higher returns over long periods of time, but the returns can be volatile and they can fluctuate largely over short periods of time. In contrast, defensive assets tend to be steadier over the long term, but the returns are often lower. I mentioned earlier the confidence gap. Generally, women tend to be more conservative with investing, and they tend to hold a larger proportion of their investments in defensive assets, such as cash and bonds, often feeling less confident when it comes to making investment decisions. Sometimes this can hold us back. We can really see the impact of this when we look at how these different assets perform over time, with growth assets generally outperforming defensive assets. Time frame is important here. Generally, high-risk investment strategies are more suitable for long-term investing. This is where it's important that you take some time to work out your goals and identify whether they are short, medium, or long-term. Short-term goals are generally defined as those that you hope to achieve within 1 to 3 years. Some examples could include paying bills, going on a small holiday, or taking time off to care for a new baby. Generally, for short-term goals, low-risk investment options are more suitable. Medium-term goals will usually fall into 3 to 5 year range. Examples could include saving for a house deposit, an overseas holiday, or even planning for a wedding. Even with medium-term goals, a conservative strategy is generally most appropriate. Longer-term goals, on the other hand, such as major renovations or your retirement, allow for more flexibility to invest, which can help deliver stronger returns. And with long-term goals, you have more time to weather the ups and downs. When it comes to investing, diversification is another key concept to understand. Diversification means having your funds invested in different asset classes. This means, in the event that one asset class isn't performing well, you have exposure to other assets that may be performing better. Diversification helps reduce risk. Think of it as not putting all of your eggs in one basket. For most of us, our superannuation will be our largest investment, and it's going to be a long-term investment. We all have different attitudes and tolerances to risk, along with different timeframes for investing. So there really isn't a one-size-fits-all when it comes to choosing the right investment mix. But it is important to remember that over the long term, even a 2% difference in someone's investment return each year can have a large impact on their retirement funds at the end of the day. There are a lot of things to consider when you're determining a suitable investment strategy. But you can get started by thinking about the goals you want to achieve and how long you have to achieve them. And don't forget the importance of getting advice to make sure that you have the right strategy in place. When it comes to your superannuation, getting the investment mix right is important. But let's now move our focus and have a look specifically at how super works and the types of contributions that are available. The super system has tax advantages that help encourage us to save. Money that our employer contributes or money that we contribute ourselves is typically taxed at a rate of 15%. For most of us, that's less than our income tax rate. So that provides us an incentive for us to save by accessing that concessional or lower rate of tax. Let's look at the specific types of contributions that are made. The government has laws in place that state that your employer is required to pay 9.5% of your ordinary time earnings, generally your salary or wages, into your super fund. Now, this is known as the superannuation guarantee. In addition to your employer contributions, you can also make your own contributions, and this can help accelerate your savings. We're given 2 options for our own contributions, and each come with their own advantages. Firstly, we have salary sacrifice, otherwise known as pre-tax contributions. Salary sacrifice contributions come out of your earnings pre-tax and help reduce your taxable income, so it may save you money on tax. These contributions are taxed at a rate of 15% once they hit your super fund, as I said before, instead of being taxed at your income tax rate. Due to these tax advantages, there are limits on how much you can contribute, with contributions currently being limited to $25,000, and this figure includes the amount that your employer pays in. Secondly, we have after-tax contributions. After-tax contributions come out of your net income. They don't have the same tax advantages as you've already paid tax on this money before it goes into the fund. Because of this, the amount that you can contribute is generally a lot higher. Depending on your situation, you may choose to make an after-tax contribution to be eligible to receive a government co-contribution. The co-contribution is a top-up from the federal government of up to $500 to your super. Whether or not you receive a co-contribution will depend on how much you contribute and your income level. Making small contributions to your super can have a big impact over time. So let's look at an example to show you the difference that it can make. In this example, we have 4 women: Kelly, Anna, Rebecca, and Kylie. For this example, we're assuming that they are all starting on a salary of $50,000. Kelly hasn't made any additional contributions to super. Anna started early, contributed $100 a month from the ages of 20 to 35. Then she stopped. Rebecca started a little bit later, but contributed for longer, contributing $100 a month from the age of 35 through to her retirement at 65. Kylie, on the other hand, has contributed the whole way through. Interestingly, what we can see is that although Rebecca contributes more, making smaller contributions earlier on has a larger impact for Anna. This is due to the benefits of compound interest. Compound interest helps your money grow faster because interest is calculated on the accumulated interest over time, as well as your original principal. Compounding can create a snowball effect as the original investments plus the income earned from those investments grow together. Ultimately though, whether you start early or late, making small contributions throughout their working lives at a time that suits them results in a notable difference in these women's retirement savings. So what can you do? Well, consider making some contributions to super. Even small amounts made regularly over time can have a noticeable impact on your retirement savings. Of course, it is important to consider your personal financial situation to determine which option may be the most appropriate for you. Next, let's have a look at insurances. So the reality is that most of us know someone that has had to take time out of the workforce, or maybe even had to retire early. We don't hesitate to insure our car or our house, but often we overlook our biggest asset, our life and our ability to earn an income. Although uncomfortable to think about, it is really important for us to consider the what ifs. This ensures that we have appropriate measures in place to lessen their potential impact. There are generally 4 main types of cover available to you: death, total and permanent disablement, income protection, and trauma insurance. You may already have some of these covers through your super. Death cover is a lump sum payment paid to your beneficiaries in the unfortunate event of your passing. Total and permanent disablement is a lump sum payment that's paid to you in the event that something happens to you and you're not able to work again. Generally, for policies in your superannuation, this means never being able to return to the workforce again. But it is possible to get cover that would pay out if you can't work in your own job. Income protection is a monthly benefit that's paid to you on a temporary basis if you're sick or injured. Finally, trauma insurance or critical illness is there to provide a lump sum of money to help cover some of the immediate medical expenses or financial needs in the event that a critical illness or injury occurs, such as a heart attack or a cancer diagnosis. Having the right type of cover in place is really important. So if you have some cover through your super, spend some time getting familiar with the details. If you're a statewide super member, make sure to review the Insurance in Your Super booklet for further information. Your cover needs may change throughout your lifetime, so it's important to review your insurances regularly, particularly if your situation changes, such as getting married, having children, buying a house, or going through a relationship breakdown. And if you do have a partner, make sure that they do the same. It's not the most pleasant chat, but it's important to have the discussion sooner rather than later. For most of us, our superannuation will be our largest asset. It doesn't need to be something that you review all of the time, but it is a good idea to check in with your super fund from time to time. To help review your situation, Statewide offer 3 different levels of financial advice that are available to you depending on your needs. The first is general advice. Our contact centre or Super Hub staff can help you understand how your super account works and tidy up things such as your beneficiaries. As a Statewide Super member, you're also entitled to personal financial advice on your Statewide Super account. This means that you can meet one-on-one with an associate financial planner, either by phone or face-to-face, to get tailored advice in the areas of investments, contributions, and insurances. An associate financial planner can work with you to make sure that you're getting the most out of your Statewide Super account. Finally, the third tier of advice at Statewide Super is comprehensive financial planning. There is a no obligation meeting first, and if you decide to proceed with advice, it is a fee-for-service model. If you would like any further information about what we've talked about today, don't hesitate to get in contact with us.
The advice in this video is general advice only. It may not be appropriate for you, and we recommend you obtain independent financial advice and consider the applicable PDS before making an investment decision.